Big tax changes are coming to India's income tax rules, and they could help millions of salaried taxpayers keep more money in their pockets. The draft Income Tax Rules 2026 to support the new Income Tax Act 2025, which will take effect from April 1st, 2026. Now, these rules redefine how exemptions and allowances are calculated, many of which hadn't been updated in decades, and could significantly reduce your tax outgo if you have chosen the old tax regime. For the past few years, millions of taxpayers have shifted to the new tax regime because of the lower slab rates and the simplicity. But the old tax regime still offers exemptions and deductions like house rent allowance, your education allowances, hostel and meal benefits, and much more, which can drastically reduce the taxable income if used very smartly. With the draft rules increasing many of these exemptions, the old tax regime is back in contention. So, what could change? Here are the biggest hikes in exemptions. 1. HRA or house rent allowances. Cities like Bengaluru, Hyderabad, Pune, and Ahmedabad are now on the list for 50% HRA exemption, just like Delhi, Mumbai, Chennai, and Kolkata, meaning salaried workers in these cities can claim bigger rent tax breaks. 2. Education allowance. Exemption per child rises from 100 rupees per month to 3000 rupees per month. 3. Hostel allowance. This jumps from 300 rupees per month to 900 rupees per month. That's a massive relief for families with kids in hostels. 4. Meal exemption. Meal vouchers or employer provided meals go from token low levels to 200 rupees per meal, potentially exceeding 1 lakh rupees per year. Now that's a massive change. Let's look at a practical slice of math based on the industry estimates. Suppose you earn 15 lakh rupees annually and claim several allowances under the old tax regime. Hostel allowance exemption 9,000 rupees into 12 is 1,08,000 rupees. Education allowance for 2 kids 3,000 rupees into 12 into 2 is 72,000 rupees. Meal exemptions 200 rupees into 2 meals into 22 working days into 12 is 1,05,600 rupees. Just from these three benefits, your exempt income adds up to 2,85,600 rupees. Now, this could substantially lower your taxable income and therefore your income tax outgo. Experts estimate that on a 15 lakh rupees salary, these draft rule increases alone could reduce your tax bill by up to around 89,000 rupees under the old tax regime compared with the earlier version of the old tax regime, even before adding HRA benefits. And when you combine all revised exemptions, including HRA and other allowances, some taxpayers could see potential total tax savings of up to 1.41 lakh rupees. So, should you switch to the old tax regime? Well, it's simple. If you don't claim any deductions, the new tax regime may still be better, especially if your taxable income is below 12 lakh rupees. But if your salary package includes HRA, education or hostel allowances, meal cards, and more, then the old tax regime may suddenly offer more value because these exemptions now cut down taxable income by larger amounts. So don't automatically, pick the new tax regime just because it's simpler. Run the numbers based on your own salary structure, and then decide. Before filing your return next year, calculate taxes under both regimes and choose the one that gives you the lowest tax liability. These draft rules, remember, haven't been finalized yet, but if they are, many taxpayers may get some more relief. What do you think about this? Let us know in the comments.
If you like this video, then like, share and subscribe to ET Now.